Welcome to the deep dive. Today, we're cracking the code on, well, one of the toughest, most energetic FinTech puzzles in Asia.
It's a fascinating one.
Right. Nepal's mobile payment market. We've gathered all the essential research, all the sources, and we're really aiming to deliver the definitive blueprint for winning in that landscape.
And it is a truly fascinating case study. I mean, for any investor or entrepreneur looking at emerging markets, this is one to watch. You're looking at a market with just immense foundational potential. Mobile penetration is soaring. It actually exceeds 130%.
Which is incredible.
And you have this massive tech-savvy youth demographic, all galvanized by the government's push with the Digital Nepal framework.
Exactly. But here's the challenge, right? This is what sets the stage for our whole deep dive. The market is it's a crowded battlefield. The sources call it a red ocean strategy, and that's spot on.
It really is.
They're just seeing these constant capital-draining cashback wars. Everyone is fighting for adoption, but they're doing it with unsustainable discounts.
And that is the problem. If you're a venture capitalist or a strategist, you have to ask, how long can this burn rate continue?
Right.
Cashback is simply a race to the bottom. It drains margins and, it creates users with absolutely zero loyalty.
So our mission today is to move beyond that superficial metric.
Beyond the cashback.
We are going to uncover the sophisticated, multi-pronged strategy that separates the fleeting contenders, the ones just burning capital, from the enduring market champions. The Isuus and the culties.
And the fundamental insight, I think, is this. The answer isn't a single magical technology. It's not a massive marketing budget.
No.
It's a blend of ecosystem strategy, deep human trust, and political symbiosis. Ultimately, these leaders are treating payment margins as just a low-cost entry ticket.
An entry ticket to a much bigger game.
A much higher value game. Data collection.
Okay, let's unpack this with the first secret.
Yeah.
To break that cashback habit, you have to shift from being a simple payment app to becoming, well, an indispensable super app.
The user's remote control for their financial world, as our sources put it.
I love that phrase.
This is the concept of the hyper-localized ecosystem. It means embedding the service so deeply into a Nepali user's daily routine that, well, removing the app would genuinely disrupt their day.
You have to move way beyond just simple peer-to-peer transfers.
Oh, absolutely. P2P is table stakes.
And the leading players, they succeeded by identifying and digitizing the highest friction, most necessary recurring payments. We're talking about things that used to require, tedious trips or paperwork.
Exactly. Paying utility bills, so electricity, water,
Children's school fees.
internet, TV subscriptions, and critically, government taxes, which in Nepal they call Rajaswa.
And that's huge. When you digitize the payment of Rajaswa government revenue, you're not just offering a convenience.
No, you're becoming an essential piece of civic infrastructure that's profoundly impactful. And every time a user adds one of these services, it just increases the platform's, its gravitational pull.
So the switching cost isn't just about losing a few rupees in cash back on a coffee.
Not at all. I mean, when a user manages their entire portfolio of recurring high-stakes payments, their water bill, their child's tuition, their taxes, all through one interface, the incentive to switch to a competitor for a tiny discount just becomes negligible. You're not just changing an app. You're trying to migrate your entire digital life management system.
So the strategic takeaway here for you, the learner, is pretty clear. Don't try to fight the cashback war on every single front.
No, identify and dominate a specific, highly sticky niche first.
Like what, for example?
Well, for instance, streamlining the really complex payment collection for Nepal's vast network of local financial cooperatives, the Sahakaris. They often act as these local financial hubs for small communities.
Okay, that's a great example.
Or maybe completely digitizing public transportation payments, which are notoriously slow and complex. Solving a specific painful bottleneck like that gives them the core strength to then expand outward and build that dense ecosystem.
That brings us perfectly to secret number 2, the phygital imperative. Because in a market where digital literacy varies so widely.
And where cash is still king.
Right. A purely digital interface can feel abstract, even risky. Trust becomes the most valuable currency.
And you just don't build that trust purely through code. You build it by creating a hybrid model, a phygital model.
Physical plus digital.
Exactly. It means leveraging a vast, robust network of human agents, The local Kirana store owners, the communication center operators who serve as the physical embodiment of the digital brand.
Our sources highlight three critical functions these agents perform that really bridge that gap between the old and new economies.
The first one is foundational. It's CICO, or cash in, cash out.
Right.
It allows users to easily convert physical cash, which they're getting from salaries or remittances, into a digital balance and then back again. Without easy CICO access, a digital wallet is pretty useless outside of the major cities.
Function two is education and support. The agents are the frontline educator. They're the ones onboarding new, maybe hesitant users.
Demystifying the technology, overcoming that literacy gap. They're a local, trusted face who can troubleshoot if something goes wrong.
And that leads to the third, and I think often overlooked, function.
Trust building. It's huge.
Huge.
When a user knows they can just walk down the street to a local shop, a familiar face, if a transaction goes wrong, it makes the entire service feel tangible, accountable.
It's the difference between an abstract server failure and a solvable human problem.
It really is.
But let me just push back on that for a second. Maintaining a dense physical agent network that requires immense investment, staffing, ongoing training. Isn't that super expensive? Doesn't it contradict the whole lean philosophy of FinTech?
It is expensive, yes, but it's a necessary competitive moat, especially in this context. You have to see it not as a cost center, but as a strategic asset.
One that competitors can't easily replicate.
Exactly. It's what allowed the big remittance companies to build their empires in the first place by investing heavily in that local trust infrastructure. The companies that win recognize that while tech can be copied, community trust and network density are profoundly sticky. They act as formidable barriers to entry.
So you're saying that in this specific market, the quality of their physical agent network is a competitive advantage, maybe even more valuable than their tech stack.
Precisely. It proves that success is rooted in a deep understanding of local behavioral economics and, trust mechanisms.
Okay, so here's where it gets really interesting. The third secret, the art of strategic collaboration.
The art of symbiosis.
Yes. To reach scale and achieve institutional legitimacy, a fintech cannot act as a pure disruptor. They have to view commercial banks and regulators not as rivals, but as essential partners.
It's a non-negotiable partnership. Fintechs rely heavily on commercial banks for foundational infrastructure. They need them for managing liquidity, providing settlement accounts.
And crucially, for integrating with the national payment switch.
Right, and we have to mention Connect to PS here. For anyone unfamiliar, this is Nepal's crucial electronic fund transfer system. It's managed by the national payment operator, and integration with this platform is absolutely required for seamless, high-volume transactions.
And that requires partnering with the incumbent financial structure. You can't just go around it.
You can't. The strategic positioning is key. Successful fintechs are viewed as the convenient interface for funds that are ultimately held within a traditional bank account, not as a replacement for the bank.
And partnering with reputable Class A banks lends massive institutional credibility to the platform.
Which feeds right back into that trust we were just talking about.
Exactly. And that relationship, it extends to the regulators, specifically the Nepal Rashtra Bank, the NRB.
Successful firms don't just wait for regulation to hit them. They actively engage in dialogue. They position themselves as responsible players in the ecosystem.
How so?
Well, they share market data, they share insights. They help the NRB achieve its own national goals, especially financial inclusion. And this proactive approach, it helps build regulatory goodwill. It ensures future policies on KYC norms, transaction limits, QR interoperability are designed to be enabling, not restrictive.
So you build the environment you need to succeed.
By being a contributor, not just a consumer of the financial ecosystem.
Okay, let's pivot now to long-term profitability, because this entire strategy only works if the fintech can eventually escape that zero-sum game of low-margin payments.
Yes.
Those razor-thin payment margins, they're the means to an end. The true, unseen engine driving valuation is data capture.
This is the core insight of the entire deep dive. Every single utility payment, every Kirana store transaction, every school fee paid, it all paints an incredibly detailed, granular picture of a user's economic behavior.
And that rich stream of transactional data is the fuel for the next phase.
Digital credit?
Right. So instead of just pouring capital into generic cashback, they pivot to personalization.
They use analytics for targeted, capital-efficient offers. They also add value for small SMEs, offering simple dashboards that show sales trends, popular items, peak hours, actionable business intelligence.
Stuff that was totally inaccessible to a small merchant before.
But the high-value opportunity, the real monetization path, connects that data directly to digital credit. Traditional banks, they rely on physical collateral or complex financial histories that the majority of the rural or lower income population just doesn't have.
They're credit invisible.
Exactly.
And this is where the real disruption happens. The fintechs use alternative credit scoring. They analyze consistency in utility bill payments, reliable salary deposits, regular transactions.
To develop sophisticated models that predict repayment behavior. They are literally generating a credit history where none existed before.
And this allows them to move from being a low-margin payment utility to a high-margin lending provider.
That is the critical transition. That's what unlocks the true monetization potential of the market and justifies all that initial cash burn on adoption.
Looking forward then, where are the two massive growth opportunities that really require this transactional data?
Okay, first, remittances. Nepal is heavily reliant on inward funds sent home by migrant workers. But that final leg of the transfer, from the bank account to the recipient, is still largely cash-based.
Right.
The company that can become the default endpoint for those remittances, instantly converting those funds into a digital wallet balance, will inject massive recurring liquidity into their ecosystem. That is the holy grail.
And the second area.
Conquering the rural markets. And this requires specialized solutions that acknowledge the limitations of the environment. You have to think less about sophisticated QR codes.
And more about feature phone compatibility.
Yes, and intermittent connectivity solutions, and creating relevant sector-specific use cases, like, say, digitizing payments at local agricultural co-ops for seeds, fertilizers, or crop collection.
So as the market expands and the stakes get higher, we have to address the Achilles heel. Cybersecurity.
Absolutely.
Our sources stress that security is the absolute bedrock of this entire ecosystem. All the trust built through that phygital network can be annihilated in an instant by a single breach.
And this demands uncompromising investment in robust, multi-layered security infrastructure, fraud detection algorithms, real-time monitoring. But we both know technology only solves part of the problem.
The most frequently exploited weakness isn't the server.
It's the user.
Scams involving phishing, social engineering, fraudulent OTP requests, they're rampant. Criminals are actively targeting the less digitally literate population with highly convincing local language scams.
And this poses a collective threat. It could annihilate the consumer confidence that the entire industry has worked so hard to build. This is where the concept of shared responsibility is paramount.
So what does that look like?
It means companies must invest in continuous, clear customer education campaigns, using simple, accessible language and relevant, localized examples.
We're not talking about a single pop-up warning here.
No, this needs to be a coordinated national effort. This is one area where the industry as a whole, working with the NRB and even law enforcement, has to launch unified public awareness initiatives.
Because failure in cybersecurity and customer education.
It's the single biggest existential risk to the entire goal of a digital Nepal.
We've reached the end of this deep dive, and I think we've successfully moved past that superficial red ocean analysis to identify the real blueprint for success. The three pillars are clear. Establishing a comprehensive, hyper-localized ecosystem, embracing the high-cost but high-reward phygital imperative to secure trust.
And mastering the art of symbiosis with banks and regulators.
All of which are driven by that unseen engine of data analytics.
For investors, this should fundamentally shift your scrutiny. You have to move beyond vanity metrics like total registered users.
Right.
You need to analyze the user activity rates across multiple sticky use cases. Are they paying their taxes and their utilities? And you have to scrutinize the strength and effectiveness of a company's physical agent network.
Are they just buying adoption, or are they earning profound loyalty through irreplaceable utility?
That's the question.
So what does this all mean for the long game? If the digital credit opportunity is the true high-margin prize, maybe consider this final provocative thought. The fintechs that succeed won't just be providing a better way to pay bills.
No, they'll become the primary mechanism for financial inclusion, identifying and extending credit, which is the most powerful tool for poverty alleviation, to millions who were previously invisible to the traditional banking system.
So this fundamental transformation of credit accessibility.
Leveraging that transactional data to bring millions into the formal economy, that is the true long-term prize for the entire Nepali economy. It's setting a global example for how emerging markets can digitize trust.